Welcome to Enterprise Design's Industry Insights, where we identify key topics in the commercial real estate industry. I'm Ann Weston, Director of Design Services.
And I'm Jessica Green, Director of Client Services. For this series, we're discussing market trends with Dallas-based commercial real estate professionals.
Today, we have with us Scott Farber with Younger Partners. Scott, thank you so much for coming.
Great to be here.
So to start us off, we're probably going to ask you a little bit of a personal question. Hope that's okay.
Depends what it is.
Can you tell us a little bit about your role at Younger Partners, how long you've been in the industry, and how you came to your current role?
I'm managing principal in capital markets at Younger Partners, and I've been in the industry a little bit over 30 years. I actually started on the ownership side and transitioned to brokerage in the late 90s and have been doing that ever since. And with my partner, Tom Strobin, we cover Texas and the surrounding states and capital markets.
So what keeps you in this industry? You've been in it for a good amount of time, so tell us.
Well, I have ADD, so I don't think I would do very well at a desk job.
Very true.
Every day's different. Solving and helping clients out and trying to solve problems. I'm a problem solver, so that's what kind of keeps me into this industry. It keeps it fresh and keeps it interesting, especially in the times that we're in right now.
Absolutely. It's like a new challenge every day that comes out.
For sure.
Everything really is ever evolving, so it's really nice to see, how people come up with different strategies. So our next question is, what is the biggest differences between the Dallas market and other markets nationwide and office buildings?
That's a great question. Well, I would say first and foremost is people want to come here. We're still having in-migration here, so if you look at other cities like Chicago, New York, and other metropolitan areas around the country, you see a mass exodus of people leaving the market. So, this is still a huge job creator, even though we're in challenging times. People still want to come here and be in this market.
So what resources do you use to assist remote workers to understand the market sector in Dallas?
What's changed when I got into the business, there used to be really no data, but you've got CoStar, which provides great data source. But if you and I'm kind of a data freak, so if you just look at the data, it's just numbers. So you have to interpret the data, what that means. And so what I try to do is take the data that they have, and I look at other compilations of other data and interpret it, and then I put out a newsletter for both office and industrial. So either the information might be a trend that's happening in the newsletter, or if somebody wants to reach out to me and call me and say what's going on, that's the way I would be able to provide the information best to our clients.
I love that you actually put your own newsletter out, because I know that probably speaks to a lot of the stuff that you're actually seeing, more of the boots on the ground.
Yeah, it's real time. So the data is what the data is, and it's historical. And then, what's the trend? And behind the trend, we're seeing it front hand because we are talking to the buyers all the time and seeing what they're looking for in the market. So we'll know how they're going to underwrite a property or look at a deal way before the data comes out and says, this is the price per square foot, or this is the cap rate. We understand what's going on and what their frustrations and what's exciting them about the market. And so to be able to translate that into a newsletter and to have real-time knowledge from maybe historical data, I think it's powerful.
So how have higher interest rates affected deals for commercial real estate properties?
Well, it's a big problem. So we can, we can segment it even further than that. The higher interest rates are causing a problem because if there's nothing going on with the property and the seller doesn't have to sell, he's not going to sell. But with the higher interest rates, the buyers adjust automatically. And it's not just higher interest rates, it's also what the lending institutions are doing. The loan-to-value ratios are changing, the amount that their money are putting in reserves, and now they're going back to what it used to be, which we call kissing the paper, which means they're actually having to sign partial or full recourse. So that changes the dynamics of a lot of deals out there, and it really restricts the amount of buyers that are out there if they can even get a loan. Mm-hmm. And if we're going to talk about office properties, that's the hardest class of property to get financed right now. It's a lack of desire, interest. Maybe there's fear about what's going on in the market. And so across the country and even in this market, it's really tough to get an office loan done on the property right now, unless we're talking about personal recourse or really low to leverage ratios.
Yeah, it's especially difficult when people are trying to get back into the office. And we're working with a lot of our clients that want to understand how to get their employees motivated to come back into the office, 3 to 5 days a week, maybe 3 to 4, with some flexibility. And the tenants can't really put the entire investment into their office. So what we're seeing is owners putting more investment into the building and making a desirable location. We've seen a lot of challenges as well.
Yeah, and we see them too. And so that's the biggest issue actually going on with the office right now is on the tenant consumer demand, they don't really know what they want to do. And if it's a large tenant, there's politics involved in it about whether it's 3 days or 5 days, whatever the number is, and getting them back into the office. On the smaller tenants, we've seen them back in the office really since COVID and, in a meaningful way. But the challenge with them is what's going on with the economy right now and their lack of ability or lack of willingness to sign a long-term lease. And so all of those factors ultimately affect the ownership because at the end of the day, when the owner is either trying to sell a property or finance a property, they're looking toward the rent roll and they're looking toward the stability of the rent roll. And when somebody says, we're going to do a 5-year lease, but we want it out after 1 year, that's a 1-year lease. Yeah. I don't care how you say it, it's a 1-year lease. And even if you had a big penalty in there, the lenders, if they're going to take a look at it, they're going to look at it as a 1-year lease. So, you're almost talking about, well, it's kind of like an apartment lease, right, at 1 year. And so if you're looking at it from that standpoint and you're saying, okay, well, how are we going to get the tenants back in there? And you're looking at the other side, which is the landlord's saying, well, I can't finance this. I can't put any more money into this property with this rent roll that looks like this because of such uncertainty in the market for the office side. Does that make sense?
Yes.
Yeah.
Yes, absolutely. Well, I know as we were talking about investments and buying and kind of the difficulties surrounding the office right now, I'm going to ask, are you seeing more investments for private equity firms in any way with that?
So if we're talking, we're going to focus on office, but if it's industrial, it's incredible.
It's incredible. Okay.
But on the office side, it really, because it's such a huge capital amount, they need debt. And if the debt's not there, or if the debt's not there in a meaningful way, you take it back to an amount which is a cash buyer. And there's not a whole lot of cash buyers out there willing to do it unless they can get the returns. And we're at this point in this time where the sellers aren't really willing to sell it at that price, where the cash buyers are going to come in. And so we're in this kind of trial and error period about trying to figure out where pricing is, if that makes sense.
So a lot of these private equity firms, they are just taking that money and going towards industrial, or are they kind of holding it?
A lot of the private equity firms and the bigger shops are net sellers of office and not net buyers.
So what are your thoughts on the trend for traditional office buildings transitioning to a hybrid model of office and multifamily, or even a complete transition to a different use?
Yeah, I'm a big proponent of that, actually, because if you look at the stock that's out there, and we're not talking about buildings that have been built, let's say, after 2010, we're not talking about that. We're talking about 1970s, 1980s, 1990s buildings. They were great at the time they were built, and now what are you going to do with them? Because there's a lot of buildings out there. And it's interesting that you brought that up. We've done many valuations and we've done a couple sales actually. We're finishing up one in Fort Worth right now where it's transitioned to multifamily, it's adaptive reuse. And we're seeing that more and more going on, but the building has to make sense, the financing has to make sense, and sometimes, in most cases, those don't line up. So we're going to end up with a situation about what do you do now? And you're also seeing a little bit of a trend where if the value of the building and the occupancy continues to drop, it's almost going to get back to land building value, land basis value, and then there may be a reuse for new construction for something else. So we're in this really interesting time about how these older buildings are transitioning and who's going to be the winners and who's going to be the losers out of these properties.
A question I have, because you mentioned that building has to make sense and also the finance of it. Can you tell us sort of in detail like what a building kind of has to have to make it a good property for that?
Well, let's talk about just the floor plates. So a 40,000 square foot floor plate building or a 35,000 square foot, it's not ideal. And then you're talking about, how do the window lines line up? And is it square, is it rectangular, is it some other funky shape? How does that work? And that's just on the building structure. And then you have to figure out, can that building be empty out and at a reasonable cost, that makes sense? Can you go refit it for plumbing for all the residences? And are you going to be able to do that? And are you going to be able to park it? Because the parking ratios on those older buildings are 3 per 1,000. And if you're talking about putting 1 or 2 residents in a unit, you're going to change that quite a bit.
Are there design-related aspects that make a building more desirable to an owner, like renovated lobby, amenities, etc., or other things that do that?
So again, I started my career on the ownership side, and when I pull up to a building, I kind of look at it from that perspective. And I always try to look at it from the tenant side walking into the building. How does that building feel when you walk up to it? When you drive up, what's the drive appeal before you even get into the building? And so I would say to a lot of building owners, address that first, because if you can't get them into the front door, if they don't want to drive by, if they don't feel safe, secure, and a warm, welcoming environment, it doesn't matter if you put a gym in some little vacant spot in the building. It doesn't matter. So I would address those first. And then you're walking in, as you come into the property, what does the lobby look like? If there's a security guard, is there a security guard station that's inviting, that makes you feel comfortable when you come into the building? Or is it just some kind of second thought of putting it there that here's a security station? So even before we talk about tenant lounges or fitness centers or any of those additional amenities or dog walking parks, you got to get them into the buildings first.
Right. There's so many buildings that are doing these redevelopments or repositionings to really draw people into the building, where it's not only a great building to see, but a great building to walk by and to be at. And it's really more of a destination as well. So we're seeing that in Dallas, where you really are trying to make the downtown area a destination, which is fantastic.
That's a big project.
So for your current buildings, what are the key factors for getting vacancies leased?
So it's interesting about that. Some of the spaces, when you walk into some of these older buildings, they might have not been leased for 10 years. At a minimum. I'm not saying, I think spec suites have their place. I don't think that every building should go spec suite crazy. But I think that the owner should at least clean up the buildings and at least take them back to white box, because most people have a hard time visualizing what a space looks like when it's like a maze and you have to go, okay, well, it's here or there. Your office could be here, but you have to walk around 3 corners to get there. They just don't have the vision. And a lot of that space isn't going to be reutilized anyway. So my thought would be on some of those spaces is just to white box them and take them back and then go from there.
I agree. I think that spec suites are a really great tool for a lot of buildings to have. But the feasibility of that for some of these buildings that can't put the initial investment in, it makes it a lot more difficult. So even if you can't clean it out, make it a white box, or at least get the access to daylight and the views in those things that really kind of make it a blank slate, then hopefully the tenants can come in and visualize what their space would be.
Speaking on spec suites, are tenants deterred by higher rental rates for high-end spec suites in a desirable building?
Yeah, so I think it depends on who the tenant is. And I'm sure you guys have seen this trend. Sometimes price doesn't matter on if they want to be in a building. But you have to look at that where they came from. So the tenant may have been in a 20,000 square foot space. And through efficiencies and because they're going to use it as a recruiting tool, they may downsize to now they're 8,000 or 9,000 square feet and the space has everything that they wanted, which is great for that tenant. But that building that they just came out of has a 20,000 square foot vacancy. Now they have to go backfill. So yes, they might have paid the higher rate over here, but really, are they paying more in their whole rent budget, or are they paying less? So you have to look at those components too.
So our final question that we wanted to ask you is, what are some of the best resources that your A&D partners can provide for you in regard to commercial real estate?
That's a really great question. Thanks for asking that. So I would say from my perspective, being able to have a dialogue, being able to have a true partnership where, like for example, if I'm selling a building, maybe it's a building that could be a conversion opportunity to resi, or maybe a hotel, or even just the smart ways to spend dollars on retrofitting a building so that the owner can get the maximum benefit out of that. So that type of partnership where it can use your creative designs without blowing the budget for a lot of these guys, I think that makes a lot of sense.
Well, we really do love being a partner for you guys at Younger Partners and with you, Scott.
Great to be here. Thank you.
And we've really appreciated you and all of your time today and all of your insights.
Yeah, this has been so great. Thanks, Scott. Thank you for tuning in to Enterprise Design's Industry Insights video podcast. Please follow us and subscribe to our channel or visit us on our website at enterprisedesign.com.
And look for our teaser video highlighting the next episode. We look forward to seeing you then.